Everybody, welcome. This is Wiley Solution Walkthrough Accounting Tools for Business Decision Making. This is the 8th edition, exercise 20-2. The textbook authors are Paul Kimmel, Gary Waniak, Joel Mitchell. What used in the presentation is copyright 2022 by John Wiley and Sons, or Wiley. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2022 by Bennett Tchaikovsky. The opinions contained within this presentation are those of myself, Bennett Tchaikovsky, and not the authors of the textbook or of Wiley. Okay, so before we say thank you to that bus driver, let's go ahead and take a look at our question. So we've got over here, we've got Grudem Company produces golf discs, which it normally sells to retailers for $7 each. The cost of manufacturing 20,000 golf discs are materials, labor, variable overhead, and fixed overhead. Grudem also incurs a 5% sales commission on each disc sold. Okay, so before we get into the specifics, what I want to do first with you is say, okay, if we sell 20,000 golf discs, what does that look like? Well, if we have sales over here, this is going to be 20,000 times 7, or 140,000 less direct materials, direct labor, variable overhead, fixed overhead. So this is going to be 30,000. This is going to be 20,000. This is going to be 10,000. This is going to be 30,000. This is going to be 20,000, and then this is going to be 40,000. But what we also have over here too is we have sales commissions. The sales commissions are going to be 35 cents on each disc sold. So this is going to be 20,000 golf discs times 35 cents each. Okay, so that's where that's coming from. This is 20,000 times 7. So my total costs in terms of looking at this are going to be right over here at $107,000. So my net income as a result of going through and selling this is going to be at $33,000. Now, what I want you to do when you get something like this is say, okay, what is our net margin? Well, our net margin is going to be our net income divided by our sales, which in this case here is 33,000. And then this over here is 140,000. So our net margin is roughly around 23%. This is going to be a very, very important number. Okay, now that we have this part over here, let's now so we now understand our existing business. Let's now go through and take a look at our new business. Okay, so our new business is what we're being offered is we're offered, McGee Corporation offers Grudem $4.80 per disc for 5,000 discs. Okay, so right over here. So this is 480 times 5,000. Okay, so it also says over here, they would, and this is what's really important, is because if you're selling something for that much cheaper, it's not going to be good, because now the company is going to expect that they can always get that price. So if they accept the offer, and it's also under brand, it's under its own brand name and foreign markets, not yet served by Grudem. The thing though is that if there's a defective product, guess who's going to deal with it? It's going to be Grudem. If Grudem accepts the offer, we'll incur a one-time fixed cost of $6,000 due to the rental of an imprinting machine. No sales commissions would result from this special order. So over here, instead of sales commissions, we'll just go ahead and add in another column. And so we're just going to call this, we'll move this over a little bit. Okay, so we're basically imprinting is going to be 6,000. There's going to be no sales commissions due. Okay, now, when it comes over here to McGee would sell this, okay. So when we go through and look at this, right, so what's going to be changing? Well, fixed overhead, because it's fixed, it's not going to be changing. So it's still going to stay at this 40,000. But for variable overhead, what I'm going to need to go through and do is to figure out what my rate is per unit. So if this is going to be, right, so fixed factory overhead is fixed. So if we take in this extra order, it's not going to increase. So my basically my rate is going to be 20,000 divided by 20,000, or a total of, add another column, $1 per unit. Over here for the direct labor, this is going to be 30,000 divided by 20,000, or and assuming that everything over here is that basically that the costs are going to remain the same. Now, remember, if you have direct labor, these costs could go up because if you have to pay your workers overtime. So if we take 10,000 divided by 20,000, my rate over here is also is going to be 50 cents per unit. So to figure out what my costs are going to be, because I'm making now 5,000 units, I'm going to take 5,000 times 50 cents. I'm going to take $1.50 times 5,000 because I'm now making, this is going to be 5,000 times $1.50. This is going to be 5,000 times $1. So over here, there's no fixed factory overhead. My sales commissions are going to be 0. I'm going to have a one-time imprinting cost of 6,000. So my total costs for the new business are going to be 21,000. Okay, so my total cost for the new. So over here, my net income is basically going to be 24,000 minus 21,000, or 3,000. So my net income for the new business is 3,000. My sales amount over here is going to be 24,000. And now my percentage, or my, my margin is about 12.5%. I would not take on this new business if I'm not going to be making that much money off of it. I also have to be extremely concerned that if I'm giving a discount, right, if I'm giving a discount of 31% off my list price, the manufacturer or the person who's buying it off me knows I'm going to kind of go through and do that again. So for this particular question, this is what, so prepare an incremental analysis. So I'm just doing this like, what's the existing, what's the new, should they accept, it should be accept this special order, why or why not? I would say no, because the profit is less. Now you're going to see books and like, let's go ahead and have some fun here. Just give me a second. Yeah, and this is why I don't agree with Wiley's solution. And what they're doing is they're just kind of saying like, okay, we're clearly coming up with the same numbers, right? So it's essentially, if they reject it, they get nothing. If they accept it, they get something. But my real problem is that, you really, what I don't like about this question is you're not taking into account the existing profit margin of the current business. And I think that's what I really have a problem with. And this is not just immune to Wiley, it's really to all of these different, McGraw-Hill has the same issue. Is like they say, oh, it's giving you a little bit more, but it's not. There's just, you have to look at your existing profit margin compared to what's going to be coming through. I just don't agree with the textbook solution. If you're taking my class, again, I'm going to expect that you're going to compute up with these percentages and you're going to say, well, does it make sense or does it not make sense? But that's where I am. In any event, I want to thank you for being with me here today. And I also want to thank Wiley for continuing to allow me to go through and to use their homework questions. I believe it's a huge benefit for everyone. So thank you, Wiley. And please don't forget to like and subscribe. If you're looking for other solutions, feel free to ask for them in the comments. Have a great day.